All right. In this last video, I'm just going to make the connection between monetary policy and the economy. Okay. So we kind of talked about this already, but we weren't very explicit why they would want to do this. So we know that, and the macroeconomy. So we know that they want to lower interest rates, and we know how they do it. So that's what we were talking about in the previous videos, but we don't really know why they want to do that. That's the part that we kind of skipped over a little bit earlier. So let's get into that now. Okay, so let's suppose we do what's going to happen. So why do they want to do this? So if it's pretty simple. So let's just look at open market operations. Okay, so let's just add something to our flow chart here. So we got, well, the Fed buys T-bills. Okay, so banks gain reserves. So more loans, they do more lending, right? And this also leads to the lower interest rate. And what's the point of the more lending and the lower interest rate? Well, lower interest rate will tend to boost investment spending. Remember, hopefully by now everyone is 100% clear. So investment spending, again, has nothing to do with financial investment. When we say investment spending, we're talking about the purchase of physical capital. So we're talking about building new structures. This could be factories. Also could be, we could also talk about other kinds of physical capital like machines, vehicles, etc. for firms, for the use of firms. And it also includes new houses, right? So we get more factories being built, or more facilities being built, more capital being bought, more new houses, right? And this also will increase consumption of durable goods, because especially in the US, people tend to borrow for the consumption of durable goods. So, for example, people borrow to buy a family car. Some people borrow to buy large appliances or other kind of large expenditures in their home. So the interest rate will have a big effect on those. Now, so that's the basic reason why. So this is called, this policy is called a expansionary policy. So when they try to lower the interest rates in order to expand the economy, right? So how does this work? Well, the basic idea is this. When would they want to do this? So let's suppose the economy is here, where our aggregate demand, aggregate supply model. So we got our economy sitting over here. So our economy is here at A. So we have a recession. We have our output gap, right? We are below our potential GDP. Okay, we got our output gap, so that means we got high unemployment. So one of the policies that would be a typical policy for the Fed to pursue in this situation, it would be to do this expansionary policy. So they buy the T-bills, the banks gain reserves, more lending, lower interest rate, and then we get the final one is the key result. We get more investment spending because of lower interest rate and the banks being more willing to loan, and we also get more consumption, especially consumption of durable goods, and it is supposed to shift. Now, I'm not going to draw it all the way back because it may not get them all the way back, at least not right away, but this will shift, right? This ends up, this policy shifts aggregate demand to the right. And that's why we do it. We do it. This is pursued in this kind of situation. The problem is we have this high unemployment, and so they can use this expansionary policy in order to increase aggregate demand and tries to push the economy back towards the equilibrium, right? So in this case, we're getting pushed back to here, we're in a much better situation than before. Remember, before we could just sit and wait for this economy to adjust, but it was going to take a long time. So typically, since the Great Depression, since following the Great Depression, typically this is what the central banks do during a recession. They do expansionary policy to lower the interest rates, and the goal is to boost the aggregate demand. Okay, so this is a typical expansionary policy.